Joining us now to share his commentary on the day's market performance is Martin Smith from Anchor Capital. Hi Martin, good to chat to you. A few movers and shakers today. We can see what's going on. Tiger Brands, of course, has been the big story.
Yeah, absolutely. I mean, our market broadly is up, mostly on the back of the PGM sector. But like you mentioned, very, very strong set of numbers out of Tiger Brands. Look, it was well guided, but if you come look at the metrics of it, revenue up nicely, you're seeing margin expansion continuing, and special dividend coming in at about 8% dividend yield, which takes the full dividend yield to about 17%, which is probably why you've seen the share price continue to tick up today, up about 6-7% as we speak. So that plus a pretty undemanding multiple of about 13, 14 times, it looks like quite a good story, even with all this good news baked in already. But very good day to be a Tiger Brands holder, as it has been over the last 12 months.
It really is, and I'll be chatting to the CEO a little bit later on about their results. Some of the other ones as well, you would have heard in our bulletin. We've got Vukile as well. Your thoughts?
Yeah, also a very kind of strong set of numbers. Like the share price is up 33% year to date, which is probably why you've seen a slightly muted share price reaction today. I think a lot of the good news is priced in, but you can see now why it trades at a bit of a premium relative to its peers from a price to book valuation. They've also got a lot of growth drivers, like you mentioned, that Spain-Portugal region, the SA rental kind of market still looks very good for them, and they're decreasing that kind of cost of rent, so cost of debt. So things are looking still very, very good for them, and we still do like the share even at these levels.
Yeah. Now, the UK budget today, we got Rachel Reeves, and I wouldn't want to be in her position. She promised no more tax reform, no more tax increases. She's done it once. It looks like she's got no choice. Are Labour about to break the rules here?
It's a good question. Like you said, you're balancing quite a big fiscal hole, plus a cost of living crisis and growth also maybe being slightly anemic. So you've got quite a lot of moving parts you've got to kind of all keep in harmony. So, I mean, like you mentioned, wouldn't want to be her. It's a very, very tough act to kind of look after all those moving parts, but you're probably going to see some type of tax increases. You're going to see some type of fiscal spending cuts, and let's see where it ends up. But I think also, just from a global perspective, also important to just take one step back and make the statement that the UK economy is only about 3% of the world economy. So how much it weighs on sentiment remains to be seen. But again, it's a very, very tricky position they find themselves in at the moment with all these things in the balance.
Talking about sentiment, I mean, looking at the United States as well, it looks like, and it didn't before, but it looks like there's going to be a rates decrease. I mean, how is this affecting markets? You can kind of see it everywhere.
Yeah, absolutely. So, I mean, I think now back to what an 80% probability priced in of a rate cut in December. And I think that's why you've seen markets have a little bit of a bounce in the last kind of 2-3 sessions. Before that, you saw markets getting a little bit weaker. I mean, high valuations, fears around AI, like you mentioned at the beginning of the show, and also worries around if that cut comes in December is probably why we saw the weakness last week. But things are moving back in a positive direction as the market starts to anticipate a 25 basis points cut in December. So things are moving positively, but it's very much been a seesaw over the last couple of months.
Yeah. Something else we've been watching is Brickell. Your thoughts there?
Yeah, I think they came out with numbers that maybe the market's not too excited about. Revenue down about 25%. HEPS now negative, so losses per earnings per share. Look, very illiquid company, so you haven't seen too much kind of price action today. But I think also just a little bit of a indicative of what's happening from an SA kind of growth GDP perspective, obviously operating in kind of the construction materials and those things. It's maybe showing that on the ground things are, again, I want to use the word again, but maybe it's a little bit anemic.
Yeah. Martin, what else are you watching? I mean, there's a lot going on at the moment. And don't give us your stock pick. We're going to get to that now, but what else are you watching?
I was wondering if it was a stock pick time
No.
or not. No, I think just everything at the moment. I mean, it's been one of the more strange markets we've encountered. I think I heard the expression, one of the most unloved bull markets in history, because it's just felt very uncomfortable the whole way along this year, even though global markets are up, local markets are up, the rand is stronger, but it's just felt very uncomfortable because I think of lots of things in the background, from geopolitics to Trump and his tariffs to interest rates to high valuations. So I think it's one where you've got to keep a very close eye on all these different moving parts. And again, what that means from a sentiment perspective, because people are second guessing themselves at every kind of step. And I think that's why you've seen the seesaw where the market goes down by 1% or 2%, then up by 1% or 2%, then down by 1% or 2%. So I think that, again, it's trying to keep a hold of the whole picture and how that's going to kind of present opportunities where they haven't been before.
Yeah. All right. Now, before we move on to your stock pick, let's take a moment to touch on which counters your industry peers are watching very closely.
I'm still a big tech person, and I've been looking at, as it recovers, we're out of the bubble territory. I think that story's starting to fade. And I'm looking at Alphabet. I think, at its multiples now, it's still very, very attractive. I think it's in the low 20s. I love YouTube. I think it's bigger than any of the other streamers. They've just released Gemini 3, which is their AI play. We've seen the headlines today. They're selling their chips to Meta, or will sell their chips. I think that's the way they're going to go, where they will be responsible for their own Gemini or large language model. They'll be manufacturing their own chips and handling, all three. They'll be handling advertising themselves and so on. So I think it's a good play for the future. It's probably, the one that I'm most comfortable about buying at these levels, as I am with Microsoft. And Meta, and which one have I forgotten? Amazon.
So I'm buying We Buy Cars tonight. We saw it come out with results recently. The stock sold off about 15% in the last month. Principally, they felt a bit of pricing pressure with the entrance of Chinese vehicles into South Africa coming in at a very good price point. So that's meant that they had to sell some of their second-hand stock at slightly lower margins. I think that they are largely through that period now. Management have said that they are largely through that period, and the growth in earnings will now start to come through again. They've grown from a 5% market share in 2021 to 10% market share, and I think that they will continue to grow. They're rolling out more representation in the Western Cape and Pretoria.
All right, so two very solid stocks there, Martin. Let's start with Alphabet. They're getting the thumbs up. They've always been relatively strong anyway.
Yes, Alphabet is a great quality company, and it's one that we hold kind of across our business. We really do like the story. My only kind of caveat to if we're buying it today is just maybe that it's done quite a lot in the last few weeks and months. I think maybe a bit of the good news is being priced in at these levels. Maybe wait for a slightly more attractive entry level. That being said, though, it is a great company and one that you can hold for the next 5-10 years or so. But yeah, just slight caveat, because it has done quite a lot in the last couple of weeks.
Yeah, and then We Buy Cars, they saw a little bit of turbulence a few weeks ago, but also getting the thumbs up today.
Yeah, so We Buy Cars is one that I would be buying today, with no caveats. I think, like was mentioned in the clip, they had a bit of a tough last reporting period. We think that that's a very temporary issue. We think that the environment for them is starting to turn positive, timing, and et cetera. And we think that it's going to deliver quite a good set of numbers in its next result. So we're buying that today.
Right, good stuff. Right, those are those two. What is your stock pick?
So we are buying the London Stock Exchange Group. Like I mentioned earlier, you've got to just keep an eye out for opportunities when they present themselves in this markets. Can't be too broad-based given the valuations that you're seeing. But London Stock Exchange Group came off a little bit. I think there were some fears around AI and the like. But if you look at the metrics of it, it's now trading at a 20 times multiple versus historic 25 versus peers at 30, growing at about 14% EPS growth over the next 3 years. It's a very defensive, high moat business, also wide moat business. We think it's a very good quality business, and one that in these types of levels, I think you can be buying quite comfortably for the long term.
Right, you're the second person recently to say you're looking at the LSEG. Yeah, absolutely. So a good, strong stock pick. Thank you so much, Martin. I do appreciate you taking the time this lunchtime. That was Martin Smith from Anchor Capital.